There's a strange thing that happens when someone opens their self-managed super fund for the first time. The screen loads, the cash balance sits there, and every choice from that point on is theirs alone. Professional fund managers have spent 30 or 40 years making every mistake in the book. They've learned how to stop making them. The average Australian sitting down in front of their own super has made none of those mistakes yet, which means every single one is still waiting to be made. And in retirement, these mistakes don't cost a few dollars. They cost hundreds of thousands. The first one is being too cautious. The average self-managed super fund in Australia sits with around 30% of its balance in cash. Professional fund managers, the people doing this for a living, sit at around 5%. They might stretch to 20% when the world looks truly scary. Think about what that really means. Say someone has $1 million in super and wants a 10% return for the year. That's a $100,000 gain. Now imagine half of that money is sitting in cash. The invested half, just $500,000, has to earn the full $100,000 on its own. That's a 20% return. Double the work for the same result. And in most years, it simply won't happen. The second one is something every broker in Australia has seen walk through the door. It's called the portfolio. Someone opens their ASX 200 list, crosses off any company they don't recognize, and ends up owning the same 12 stocks as every other DIY investor in the country. The four big banks, Telstra, Woolworths, Wesfarmers, Coles, BHP Rio, Fortescue, CSL, Transurban. Nothing wrong with any of those companies. But if the end result is basically the top 20 of the ASX, why bother with all the paperwork? A single exchange-traded fund tracking the index does the same job in one line item. Mistake 3 is chasing yield. Any stock advertising a yield above 10% almost never delivers it. Either the forecast is wrong and the dividend gets cut, or it's a one-off special payment and the share price drops harder than the payout on the ex-dividend date. There's a deeper problem with focusing on income during the accumulation phase. It corrals the whole portfolio into low-growth companies. The Australian banks are some of the best income stocks in the world because they've stopped trying to grow. They just pay the earnings back as dividends. Perfect for a wealthy retiree. Wrong tool for someone still trying to build a nest egg. Then there's the habit of only investing in Australia. This one deserves a fresh look. Exchange-traded funds now make it possible to click one button and own the S&P 500, the Nasdaq 100, or the Magnificent 7 tech giants straight from an Australian brokerage account. The AI trade, semiconductors, cloud computing, global networking. None of that exists at any real scale on the ASX. Australia is a small, resource-heavy, bank-heavy market that has trailed global tech badly over the past 18 months. Next is the false choice between fundamentals and charts. Warren Buffett and Benjamin Graham built their names on fundamental research. It's brilliant for one thing, telling an investor how safe and reliable a company is. It doesn't tell anyone when to buy or when to sell. On the other side, traders who only look at charts end up treating BHP the same way as Commonwealth Bank. That's a mistake. BHP is a cyclical resources stock that swings hard with commodity prices. CBA is a steady income machine. Both tools matter. Using only one is like driving with one eye closed. The sixth trap is a newer one. It's the belief that all exchange-traded funds are safe just because they're ETFs. They aren't the same product. A broad ASX 200 ETF, a leveraged NASDAQ ETF, a thematic uranium ETF, and a high-yield credit ETF are wildly different tools with wildly different risks. The seventh one drains real money from Australian portfolios because 25% of the ASX sits in the resources sector. Treating cyclical stocks as long-term buy and hold doesn't work. Iron ore, lithium, nickel, copper, all of them move in commodity cycles. Years of pain, then explosive upside, then pain again. Anyone who bought a lithium stock in early 2023 knows exactly what that feels like. Resources are packed with opportunity, but they need to be traded around the cycle, not tucked away for a decade and forgotten. Number 8 is buying stocks on tips. At every dinner party, someone leans in, drops a company name with a knowing look, and mentions the gain they're already sitting on. Here's the rule almost nobody says out loud. People talk about stocks they already own. By the time the tip reaches the dinner table, the easy money is usually gone. The person sharing it is really just enjoying the bragging rights. Write the name down, do the research, take full responsibility for the decision. Buying anything on a whispered tip is one of the fastest ways to lose money on this market. Then there's trading too much. Day trading looks exciting on social media. In reality, making $100,000 a year from day trading is an all-day, high-stress job. The same person could earn more with less stress in almost any professional role. Short-term thinking rarely builds long-term wealth, in the market or anywhere else. Planning a financial future by staring at 15-minute charts is like planning a road trip by looking at the bonnet of the car. If a spouse came home every night bragging about another win at the market, that's the exact person who should not be running the family's retirement money. Number 10 is developing faith in a single stock. Everyone knows someone who bought a fractional cent speculative company, watched it run to 20 or 30 cents, felt like a genius, and then rode it all the way back to zero because selling would have felt like giving up. Stay objective, watch the price, take profits along the way. A share price doesn't care how much anyone loves the story. And now the biggest one, the one that really decides how retirement looks 30 years from now. Don't ignore superannuation, especially at a young age. Australia's super system is one of the best retirement setups in the world. The tax treatment is a genuine gift. Contributions inside the concessional cap are taxed at 15% instead of a marginal rate that can climb to 47%. Earnings inside a pension account after retirement are tax-free up to the transfer balance cap. The baby boomer generation had houses that went from $200,000 to $2 million, but they didn't have a 30 or 40-year runway of compulsory super contributions the way younger Australians do today. Taking super seriously can change everything. Salary sacrifice an extra few $100s a month. Use catch-up concessional contributions when the total super balance is under $500,000. Stay in a balanced or growth option instead of defaulting to cash. From the 1st of July 2026, the concessional cap sits at $32,500 a year. The non-concessional cap moved to $130,000. That's serious room to accelerate contributions. There's a new rule to be aware of too. Division 296 came into effect on the 1st of July 2026. Balances above $3 million now attract an extra 15% tax on the earnings tied to the amount above that threshold. For the vast majority of Australians, that ceiling is still a long way off, but it's a reason to plan the path properly rather than treat super as a bottomless tax shelter. The super system is an Australian gift that most people never fully use. The younger the starting point, the more the compounding does the heavy lifting. If you got value from this, do me a favor and hit the like button, subscribe to the channel, and turn on notifications so you don't miss the next one. I'll see you there.